Okay, hello everyone. So it's session 23. If you like to follow along on Moodle, it's starting learning AIM F5, measuring efficiency. So it's the last of our ratios. This is session 23 on Moodle, but for video purposes, I've separated into 23A, which was F4, and 23B, which is F5, and just so that the videos aren't so long and they can be condensed. So if you are starting F5, you need to go on to slide 27, and that's where we will start this session. It's if you're following along on the worksheet, it's page 6, and you should have your worksheets from last session. So today's learning objectives, it's to define the term measuring efficiency, how measuring efficiency is calculated, what measuring efficiency is used for. So those are our three learning objectives in this short session. My video will probably be about 25 to 30 minutes long, but realistically taking you 30 to 45 minutes to work through, but you work at it to ensure that all the content comes in. It takes you an hour and a half. It takes you an hour and a half. So we are moving on nicely. F5, we've got two sub-learning names left, F5 and F6, and that will be all of your content complete. As always, you're bored of this by now probably, but it's so effective. The more you do, the more you practice, the more you actually having a go at the calculations. If you can then teach others, it stores in your long-term memory. There is only so much working memory that we have in terms of capacity. There's only so much new information you can actually take in. That's called working memory. So what we try and do is then store into your long-term memory, because that is endless. There is no full limit of long-term memory. You can keep adding new information after new information after new information. So way that we can help store into our long-term memory is by teaching others, by practice doing, and by discussion, i.e. active learning. If you're just listening to this video, you will not retain that information. So measuring efficiency, there are three formulas that we need to be able to do and learn. There is calculate, interpret, analyze, and evaluate of trade receivable days, trade payable days, and inventory turnover. Now, all of these terms we have seen before on Learning AIM F1 or F2. Calculate would be a 3-mark question. Interpret and analyze would be a 6 to 8, and the evaluation is 10 to 12. As previously, you've been given a handout that was within session 22, and you should be now working through those and using those as a guide. You need to learn them. These formulas will not be provided to you. So define the term measure and efficiency. So question 9. So what is efficiency? Teacher to pause the video, give the learners 1 minute to think about what the word efficiency is, and can we relate it to finance? I'll carry on in 10 seconds. So the answer is measure and efficiency. It's assessment that makes an assessment on the efficiency of a company. It allows companies to stay efficient and competitive by keeping inventory levels down and speeding up the collection of monies that they're owed. It also allows us to determine how productively a company manages its assets and liabilities to maximise profits. Got a right tongue twister today. So slide 34. Measuring efficiency. These are our three ratios that we need to know. And they all end in 365. So teacher to ask, why 365? Why are we using that number? So in order to calculate trade receivables, you need to know your trade receivables divided by your credit sales times 365. Trade payable days, trade payables divided by credit purchases times 365. And inventory turnover is the average inventory divided by the cost of sales times 365. And we should have correctly guessed that the reason why it's 365, is because that's the number of days in the year. And that is what we're measuring. We're measuring how efficient our business is at paying its debts, collecting its debts, and how on average it takes us to turn over the inventory. So how often do we sell our stock? So firstly, we're going to start with trade receivables. So trade receivables means on average the number of days debtors take to pay. So once you've provided credit to a business and you've provided a business who you are supplying to 60 days credit, we will be efficient if our business or our the business who is paying us, i.e. our debtor, pays us within those 60 days. The shorter the figure, the better the organisation is at collecting their debts. Now, it is only compared to the credit term, though. So, if our business is provided 30 days credit, and as you are allowing your debtors to pay you in 30 days' time, the ratio will be based on those 30 days. So, if they're paying 29 days, you are efficient. If they're paying 30 days, you are on track. And if they pay in 31 days plus, you are off track, for example. Obviously, thinking back to learning aim E1, on your cash flow, if you are providing 30 days credit, you are expecting the businesses to pay you, your debtors, in those 30 days. So cash flow is a prediction. So therefore, if you are taking longer to collect your debts, your cash flow will be incorrect. Therefore, you may be utilizing the cash in your business not effectively because your forecast is incorrect. So a couple of questions. So question 11, calculate the trade receivable days. So have a think about what you might need to do. And it's trade receivables divided by credit sales. So for this example, you've got £600,000 trade receivables divided by 1.3 million credit sales. 1, 3, and then 5 zeros. So you do your 600,000 divided by 1.3 million, giving you 0.46. Now, with that 0.46, we times by 365, which gives you 168.4. And teach you to write this information up on the board. So, for example, using this answer and using this question, it takes us, on average, 169 days for customers to make a payment. Now, at the moment, that doesn't mean anything because our credit term might be 180 days. It might be 30 days. We'll be using these figures later on. Slide 38, trade payables. So trade payable is when you are paying for the trade. So it means on average, the number of days it takes you to pay your creditors, i.e. your suppliers. There is a belief that this should be greater than trade receivable days, but could mean a company relationship with supplier is damaged or is given a poor credit score from creditors if you pay later than your actual credit term. Companies can use the difference in finance from trade receivable days to trade payable days and use this finance to gain interest. For example, if you are given a credit term of 90 days, the reason why that business is giving you 90 days is that it's on credit. Now, if you pay on day one, you could have been generating interest from that cash in your bank. It could be in a savings account, a business savings account for 89 days, generating your business interest, gaining money for you instead of paying on day one. Often, companies will give you discounts by paying early, so you need to weigh up the benefits of paying early versus paying on time. So, question 13, trade payable days. Our trade payables is 200,000 and our credit purchase are 900,000. Have a go. Pause the video and see if we can get it right. Answer in 10 seconds time. So you may have correctly guessed what you need to do for this answer is 200,000, 2 and 5 zeros, divided by 900,000, which would have given you 0.22. Times by 365, 365 days, that gives you an answer of 81.1. Therefore, 82 days to pay your creditors if we're rounding up. And again, this doesn't really mean anything at this point because you don't know the credit term. The credit term might have been 80 days, therefore you are 2 days late. Therefore, that is going to negatively affect your relationship with your creditors, your suppliers. That might have been a bank, and therefore you've been charged interest on those 2 days. You may have lost 0% balance interest free. It might be 90 days and you've paid 8 days early. Might build a good relationship with your creditors, but that money in that bank is not generating you interest when you've paid another business. Question 14, inventory turnover. So inventory turnover shows on average the number of days stock is held for. Ideally, the lower the figure, the better, as stock is being sold quickly and therefore not depreciating. So pause the video and can somebody answer, what is a depreciation? Define the term. And then, what are the two methods? I'll carry on in 10 seconds. Depreciation is a loss of value over a period of time. It relates to an asset. So you own the asset. So if it's your stock, you own that asset. The two methods, a straight line, of which the balance does not change across its years. So if it's 4 years, it depreciates £4,000. Therefore, it's £1,000 per year. And secondly, which is the more realistic figure, but it's more complex, is the reducing balance, which works off a percentage. A low inventory figure may mean that stock is not priced effectively. You could increase your price, hold your stock for a little bit longer, but you make more gross profit when you sell an item. If your stock is priced too low and it is being sold too quickly, it might be a negative. It might actually mean you could increase your price, meaning more sales revenue, meaning more gross profit. So have a go. So average inventory. So the average. What does average mean? What do we mean by the average? So how we work out this is we've got our opening inventory. So it's what we started with. And then our closing is what we're ending with. So what you do, because you want the average, you want the mean between both numbers. So opening inventory plus closing inventory would give you £400,000. £450,000, sorry. Now you want the average, so you divide that number by 2, which gives you £225,000. So now you've got the average inventory, you divide that by cost of sales, which is £900,000, which would give you the answer of 0.25. 0.25 times 365 equals 91.25. You can't have 0.25 of a day. Therefore, we are going to round up, and it's 92 days to calculate the inventory. Therefore, every 92 days, the inventory turns over. And the answers are on the screen. So over to you. You've got 10-15 minutes. Pause the video and answer the question. Write a short essay, so it's 100 to 300 words. Make an assessment on how the company is performing. So it's 169 days trade receivables, 82 days trade payables, and 92 days inventory turnover. Now, this is a not one size fits all approach, because what you may need to do, and you will do, is set yourself a credit term for all of these and what you want it to achieve. So, for example, if you set yourself your business as trade receivables as 170 days, 180 days, what does 169 actually mean? If you set your business of 90 days trade payables, what does that 82 days actually mean? An inventory turnover, if you've set your business at 90 days, or let's say 150 days, what does that 92 days mean? Pause the video, allow learners to have 10 minutes to write an answer. Maybe every 2 minutes stop and just take some information, bullet points from each person, from a couple of people, to give everybody else a support and maybe some sentence starters. In 10 seconds, I will show you the answer. And we're nearly coming to the end of F5. And then I'll be handing it over to you to actually have a go. So on the information on the board is an example. It doesn't mean yours is wrong, because I might have used different credit terms than you. So pause, allow to read or read out. I'll move on to the next slide in 5 seconds. So as I've said previously, what does this tell us? These ratios are only comparable to businesses of the same size, of the same competition, with the same standard industry, in the same industry standards at the same period of time. They are not able to compare business from business year on year. All it is able to do year on year is compare your business from year 1 to year 2, or year 1 to year 5, or year 1 to year 10. There are limitations to these ratios. They are not the be all and end all. They are there as a supporting mechanism to make a rationale of a business, but it does not show the whole picture. It only shows it from that point of time and purely on a financial point of view. It does not show the business's overall picture. So have a go. So same tables that you've seen previously. These questions are on your worksheet. It is on page 8, and you will need to determine payable, creditor, and inventory turnover days. Year 1 and year 2. Remember the ratios from previous. Use your worksheets. use your knowledge organisers. It does say homework, although it's just that I've not amended my slides before doing the presentation. It's not homework, it's an actual activity. Pause for 10 minutes, allow learners to have a go, and then we'll move on to the answers. I'll move on in 10 seconds. And the answers. So the answers are on the screen. I've not showed you how we've got there. So what we would like to do is to go through the answers individually. So if you got 104, I want you to describe how you've got there, and the teacher will write it on the board. So it's 104 in year 1 and 76 in year 2. Year 1, 30 days receivable, 32 days in year 2, and inventory 48 days in year 1 and 55 days in year 2. So what does this actually mean? So for 6 to 8 marks, assess the overall performance of the business in its second year of trading. 15 to 20 minutes to write an answer. And in 10 seconds, I will go through some examples. Some things that I do want you to make sure that you've put in there is, what is trade payables? Does that mean that the business is more efficient or less efficient? Receivables, is the business more efficient or less efficient based on the numbers? What about the inventory turnover? It's increased. So what could that mean? What does that actually mean to us? And here are the answers. Now, just bear in mind, you haven't been given the credit term. When you do come to answering these questions, you will be given the credit term for payable, receivable, and inventory turnover. So the answer, or an example answer, is on the board. Have a look. I'm going to pause the video now and read through the answers and see if it matches up with yours. I will then move on. Okay, so I'm going to move on to the end of the session. So that is the end of the session. So well done. Well done for completing all of that information. Before you leave, there is going to be an exit pass. And that exit pass, again, is what you've done previously. So identify another learning aim. Show intended practice. Don't just choose a random one. Don't go, I'm going to do A3 and current accounts, and that's it. Be specific. So go learning aim A3, current accounts, and I'm going to look specifically at what premium is, because I just can't get it nailed down in my head. Or you might look at the advantages for all three. Do some flashcards. Do some little quizzes for yourself. What is an advantage of all 4 types of current accounts? Be specific on your practice. What are you going to do to develop? Come up with a plan. I've given you different types of revision materials. You can use revision clocks, flashcards. You can make little quizzes. Make a Kahoot quiz yourself if that's what you like. Doing that, you then might be able to share that with somebody else. Therefore, you're helping to teach others. That retention pyramid. Who else can help? And what other resources are you going to use? Utilize other businesses out there. This PowerPoint is based off Be Business Bee, just in a PowerPoint format. Go back onto their YouTube channel, their website, have a look at it. Look at Mean Business, look at Tutor to You, look at Khan Academy. What other resources can you use? Okay, so well done. So that meets F3. So by the end of now, F3, F4, and F5, that now means you should be able to calculate liquidity, profitability, and efficiency. You should be able to interpret the data for F3, F4, F5, and you should be able to assess what that information would mean on a financial document. So well done. I'm going to end the video now.